up on the week. Similar move in the bond market. Yields right now, 2s, 10s and 30s, shaping up as follows. Unchanged on the day, but down aggressively on the week. On a 10-year, much more so on a 2-year. Tom, we're down 3 basis points today on a 2-year, down more than 20 on the week so far. We're sub 420 on a 2-year.
We never know with the standard error, the mistake that can be made in payrolls, what the news is, but let's say we get the whisper number.
The downside surprise.
Like if we're not 200, we're 170, we're 150, whatever the number is, what in the market will unravel? To me, it's fascinating, given the 2 months we've had in the equity.
I'm going to suggest it would endorse the move we've seen so far this week already.
It will endorse what we've already seen with the VIX through 20.
Based on what we heard from Chairman Powell earlier this week, Lisa, and the way we responded to Chairman Powell on Wednesday.
It depends on the wages, though, as well, and
Sure,
the hours worked. And I think that people are going to be looking beneath that headline number because it has been so noisy and so messy.
I looked carefully 2 days ago at the inflation-adjusted wages. There's a number of ways to look at this, and all I can say is the level and duration of the negative real wage is jaw-dropping for so many Americans.
There's a big question as well about what the actual hiring will be, and I want to take a look at some of the companies that are in the areas that are struggling the most. Marvel Technology is a chip maker and put out some negative earnings, negative outlook. You could see the shares going down pretty dramatically, down more than 5% ahead of the open. Open Door, right? This is flipping houses, not exactly the place that you want to be going into, and they've just lost another member of the executive team, and they are struggling as well. Those shares lower even still. I mean, look at that. They're $1.81. It's not like they're coming down from a pretty high place, going with losses of about 2.7%. And Blackstone, I want to pick up on what both of you were talking about. The story overnight about withdrawals from their $125 billion real estate investment fund, the BREIT, that they seem to exceed the quarterly limit. So they gated it, or they restricted some of the outflows, which really suggests the souring type of sentiment around commercial real estate and how quickly global money is moving.
This is really important because commercial real estate has a duration of debt that's not 30-year mortgage or whatever. I don't even know what commercial real estate does in London, John. Here, it's like a 7-year roll. So when commercial real estate booms, boom, it booms, and you get your money out. Or if it falls apart, like that, gone.
Well, to be clear here, they're saying this is not about the performance of the fund, right?
The fund is, they're heated to the Financial Times yesterday.
Not about the performance.
They got it wrong. We're making 9% to our customers. This is not a Credit Suisse kind of event.
But clearly, TK, as you've pointed out, there's liquidity issues with these kind of funds. Just by definition. By definition.
Yes, absolutely. And the beast of commercial real estate and all the REIT challenges over the last 40, 50 years. But to partition this, there's a notoriety of Mr. Schwartzman's company, John Gray's company, with residential real estate nationwide. Are they buying up Kansas City so you can't get a home versus commercial real estate, which is more that 7-year duration?
Well, this really does speak to a liquidity problem, essentially and fundamentally, because if big investors are getting worried and they can't withdraw from funds that are protected against having fire sales, how much does that create an even greater aversion for going into some of these funds that really don't prop up some of the valuations longer term?
Let's get a brief here, and we'll get a brief here on job economy, 57 minutes away if my math is right. He has better math than me. Michael McKee joins our Bloomberg Economics and Policy correspondent. What is a distinctive feature in 55 minutes, Michael McKee? What matters?
I think Lisa gets the prize today. Basically, she noted the average hourly earnings is going to be important. And that's really what's going to matter to the Fed. On Wednesday, Jay Powell came out and divided inflation into 3 categories. One was rents, one was goods, and one was services. And he notes that rent prices are coming down, not reflected in the data, but the Fed knows what's happening there. Goods prices have backed off some, but it's services prices that are still contributing to inflation because they can't find workers, and so they're bidding up wages to try to bring them into the labor market. And so if that starts to slow, then the Fed will be happy. I don't think it's going to change much as far as the December 14th meeting, but a move in the right direction would be helpful.
Are we done with a Federal Reserve that's going to push back against financial conditions easing?
You have to wonder if they think it's even worthwhile anymore. I went back and looked at a bunch of charts this morning, and financial conditions started easing. At the same time, the stock market started to go up and bond yields started to go down, which was the day that we got the September CPI report, which was stronger than necessary. And you would have said on that day, well, it's a recession scenario. And then we got the October report, which everybody said was, oh, soft landing, but it didn't change the trajectory of any of the markets, and it didn't change the financial conditions indexes. So you wonder if the Fed is going to say, financial conditions are still pretty tight, they've come down some, and we can't jawbone these people anymore.
Mike McKee, Jim Glassman at JP Morgan has been absolutely brilliant about saying the gloom of labor is off the mark. He reaffirmed that yesterday with Paul Sweeney and myself. What does small business say across the nation?
Small businesses are in sort of the same position. They've scaled back their hiring plans a little bit, but still a big plurality of them say they can't find people to take jobs. And that's the problem for big companies and little companies. There's still more than 10 million job openings, and about 6 million hires, according to the JOLTS report last month. So there's 4 million jobs going begging somewhere. Obviously, there's skills mismatches, but as Powell suggested on Wednesday, finally coming around to the idea that the participation rate won't matter much anymore because he doesn't think people are coming back in.
Interesting.
Excessive retirements, excessive mortality due to COVID, and the labor market is just going to be weaker going forward. The number of people who want jobs, not enough to fill all the jobs out there.
Mike McKee, we're lucky to have you. We're going to catch up with you a little bit later, going into payrolls and coming out the other side. Mike McKee there. This from Drew Madison, MetLife. And I'm pleased we've got Ellen Zentner and Morgan Stanley with us, Tom, because I'd love Ellen's thoughts on this. Drew says decisions to provide raises lag. This is why annual increases take time to show in paychecks. Hours are set week by week. He thinks wages that today are less important than hours worked. If you had tremendous difficulty hiring, do you fire first or reduce hours?
That's called Maury Harris 101 at UBS when young Drew Mattis worked for Dr. Harris.
It's an interesting take, isn't it?
Yeah, well, they like Ellen Zentner, Drew Mattis was on a team that won every award out there and trying to figure the game out. We are thrilled to bring you Ellen Zentner of Morgan Stanley. I want to go to how you became regarded on Wall Street, which is your measurement of the American consumer. How is the American consumer? It was been waiting, the gloom, the recession. Do we all agree we see a boom still with the American consumer? What's the state of the American consumer this jobs day?
So I think the state of the consumer is better at this point in the cycle than we've ever seen, and mostly because of balance sheets and because of job gains. But it's not equal across the income distribution. We saw that lower income households earlier this year had moved through and spent through the excess savings that they had. So that was what was helping them deal with higher inflation. But wage gains continue to be strong. And as long as we're creating jobs and the wealthier households are spending, then you're going to see aggregate consumption remain pretty resilient.
There's a big disconnect then in people who are heralding the end of peak inflation and a move away from that, and people who are still seeing the resilience. And there's a real sort of mismatch in how Jay Powell is discussing this as well. Does he seem to still believe in transitory, and is he basically giving a nod to that?
No, I think we've shut the door on transitory, and I think future chairs will probably be less apt to use that term. But it has shown a lot more confidence of late. I mean, this was really a surprise this week when he spoke at Brookings of just how confident he was that inflation will come down, and that was a big shift for him from needing to see it to in the data to I'm pretty confident it's going to come down.
What do we have to see today in the labor market and in the upcoming prints with CPI and heading into next year to confirm your call that the Fed could start cutting rates as soon as December of next year, even as they say, we're not going to do it, we're not going to do it?
Yeah, so I think we're going to have to see continued softening, right? So jobs, it's a great day for economists because we love dismal data, and I'm out here heralding.
Why are you looking at me on dismal data? Look at Lisa.
You've got the map of dismal on your face, Tom. No, so yes, Lisa gives me more optimism.
Sanders killing it.
If someone tells you that Lisa
Steve
gives you more
Roach would never say that to me.
Yeah, but we want softer jobs. We want softer jobs. We want softer inflation on a month-over-month basis. We want to see that progression.
You turned on a dime. I don't know when it was, John. You're better at this than I am. I'm going to say February. You were all transitory, and you just came out and said, boom, I'm wrong. What's the thing right now that could be your new transitory where you say, boom, I'm wrong? What's the attribute? within the Morgan Stanley team?
Well, I think, last year when we came out with our year ahead outlooks, our big call was that inventory building was going to be huge this year. And that was going to create a lot of downward pressure on inflation. And it just didn't come through. And we admitted that early in the year, moved away from that call, which is very important to do. But it could end up being just timing, right? Because now we're seeing the inventory to sales ratios are not that out of whack. There doesn't need to be a lot of inventory building that happens outside of certain sectors. But if we're wrong and you do eventually get that broad inventory building where there's overbuilding, then we're going to miss to the downside on inflation next year.
I look at this, and again, the word I use is swirl. James from Australia just emailed in and said, make another good call, Ellen. That would be James Gorman. I want you to summarize the mystery for you as you try to make an outlook. Farrell here says all outlooks should start March 31. I mean, that's a solution to the silliness that we go through with outlooks.
Not Morgan Stanley's necessarily, just to be clear here.
No, I love
just
the way
think it
I've
takes
said
3
this
months,
3 times this
takes
week.
3
They
months
fight
to
like
figure out
cats
what
and
you're going to be
dogs.
wrong
Is
about.
that because first quarter is sort of
I think
uncertain,
usually
a lot
it
of
takes us
volatility,
about
so,
3 months to
yeah.
find out how bad the
Because they're all
consensus
wrong,
was.
he's saying.
Around the fractious, I mean, Steve Galbraith invented this with Steve Roach and all that. It's Dick Berner, it's fractious. What are you guys screaming about off payrolls, off inflation, to the Fed meeting that frames your year ahead outlook? What's the distinction you're arguing about?
So the distinction to us is that one, the Fed does not need to hike until they get down to their 2% goal, but that they do need to hold rates steady, high for a time. And we were pushing this before more monetary policymakers were jumping on board with this. It's something that investors are still trying to grasp, but haven't fully grasped. Because
we got to talk about this 2% thing.
Yeah, well, I think that, look, there was reason for a lot of optimism after Powell spoke this week at Brookings. I'm not sure I agree with how much optimism creeped into markets after that, because real rates are going to continue to rise. They're going to rise throughout next year. And basic 101 on equities is, I don't think equities like higher real rates. And I don't think that that's been realized yet.
Ellen, we're lucky. You're going to stay with us for another segment. Ellen Zenner and
She's
Morgan
gloomier
Stanley.
than Mike Wilson.
Are you calling
Not
Ellen
possible.
gloomy?
She
now?
just said real rates are going to go through
Mike
the
Wilson
roof.
pretty
The stock
bullish
market's
into.
going to go to 10.
Mike's pretty bullish into year end.
Yes, it flipped.
Into year end.
Into year
Are
end,
you
and then things get
speaking
bad
terms?
for first quarter.
Yes, of course.
with Mike Wilson?
Yes.
Oh, okay, because we're
You're
not
trying to
on
cause
speaking terms.
trouble at Morgan Stanley.
Whatever.
I'll get him in here.
We'd love to have both of you in together. I'll
Great.
sit. I'll go take a break, and you can talk. With the desk the way it
Do
is.
a year end thing.
Do a year end.
We
Mike
can find
Wilson,
another spot at the end
Ellen.
of the desk.
March 15th.
I'll sit in the timeout chair over
Do the
there.
March 15th look ahead thing.
Exactly.
In the next hour, 8:30 Eastern Time, when you get that jobs report, Mike McKee's going to break it down. Then we'll hear from Jeff Rosenberg of BlackRock. Looking forward to that. In the hour after that, in the 9 o'clock hour, we've got Rick Reeder for you from BlackRock. Mohammed Al-Arian's going to weigh in on all of this as well. You catch up with Secretary Walsh. We'll get Mike Collins of PGIM and Anastasia Amoroso of iCapital. Quite a lineup in the 9 o'clock
You're very
hour.
railroad. Have you ever owned the 4 railroads in Monopoly? Did you own
The
all
4 railroads. No, I
at the
used
same
to.
time?
Always used to
Yes.
I used to aim for Park Lane and
And Boardwalk
the
and all
big
that.
ones.